Good afternoon, everyone. My name is Leslie Gaddis, and I'm one of the advisors here at LifeTime Asset Management, and I want to welcome you to this episode of our Lifetime Learning Series. Today's topic is one that I've been looking forward to covering because it has been in the news quite a bit lately: student loan forgiveness. But before we get started, I wanted to let you know that I won't be taking questions during the webinar, just due to the complex nature of student loans and the fact that each borrower's situation is unique. However, I will be happy to take questions offline after the webinar. You can contact me directly at leslie@lifetimeassets.com, and I'll post my email address on the last slide so you can see it. Also, we are recording this session so you can rewatch or share with friends and family later. So let's begin. First, a bit about myself. I'm a wealth consultant and the Director of Financial Planning Services with LifeTime Asset Management. I spent the first part of my career as a Geographic Information Systems specialist for a natural gas utility, but in 2016 did a complete 180, decided to pursue my passion for personal finance and financial planning. I enrolled in the Duke University Executive Certificate in Financial Planning, where I met fellow Lifetime executive team member Alan King. I completed the program in May of 2017 and passed the CFP exam a few months later. And then I joined Lifetime Asset Management in January of 2018, and I haven't looked back. So to start us off, I wanted to note early on that not all student loans are eligible for the types of loan forgiveness we will be discussing today. Private student loans are not eligible for loan forgiveness, period. And there are certain federal loan programs that are not eligible for all types of loan forgiveness. So hopefully I can clarify for the viewers which federal loan programs may be problematic and what steps might be taken to become eligible for loan forgiveness. So let's dive in. I'm going to share my screen. So first, before we get into the main topic, let's talk about recent developments on the student loan front, mainly in response to the COVID-19 pandemic and the resulting economic hardship that many folks have been facing. So last March, the Office of Federal Student Aid suspended loan payments, stopped collections on defaulted loans, and waived interest on federally owned loans. Then the CARES Act, and that was done by executive order, but then the CARES Act was passed on March 27th, which made all of the above relief measures law through September 30th. Since then, those temporary relief measures have been extended several times, and now they are currently set to expire on September 30th of this year. So barring any future extensions, payments will resume in November. So it's important to note that if you are currently participating in a student loan forgiveness program, you are actually being credited for payments towards forgiveness if your loans are eligible for the COVID-related deferment. So that's good news. And then one last bullet point. So the American Rescue Plan that was just passed makes the treatment of all types of student loan forgiveness non-taxable through 2025. And this is an important point, and it's caused speculation that the Biden administration is poised to announce some form of widespread student loan forgiveness. As I will discuss later in the presentation, certain loan forgiveness programs result in what we refer to as a tax bomb that many borrowers may not be ready for. So I'll talk more about that later. So what's been proposed? What may be on the horizon? So progressive Democrats have lobbied for loan forgiveness of up to $50,000 per borrower, but President Biden has set a more modest goal of $10,000 per borrower. Now this latter goal, the $10,000, would actually wipe out debt completely for 15 million borrowers. So it would impact quite a few people. In addition to this broad forgiveness that anybody who had a federal loan, an eligible federal loan would be eligible for, there may be some more specific loan forgiveness programs. So some of the ones that have been proposed are attendance at a public university or college, or at a private historically Black or minority serving institution. Also for undergraduates, or if you earn less than $125,000. So those are just a few ideas that have been thrown out. Also a new public service loan forgiveness program. And I'm going to go into the current program later, but this new one that's been proposed would automatically cancel $10,000 per year for up to 5 years. Just another proposal. Again, none of these are reality yet. Biden has also proposed a new income-driven repayment plan for undergraduates, under which the borrower would pay 5% of discretionary income and forgiveness would be non-taxable after 20 years of payments. So at this point, it's anybody's guess what might actually come to fruition. But at most, we are probably looking at across the board forgiveness of $10,000 per borrower and possibly some tweaks or improvements to existing loan forgiveness programs. So before we get into the nuts and bolts of some of the forgiveness programs, we need to review some important background. First of all, the types of forgiveness programs available are dependent on the student loan program that you participate in. And again, we are only talking about federally backed student loans. Private loans are not eligible for forgiveness. So there are two main federal loan programs, the Direct Loan Program and the Federal Family Education Loan Program. Direct loans are just as they sound. They are issued and held directly by the federal government, although the Department of Education contracts with loan servicers to administer the loans. And some of those common names that you might hear are Navient or Nelnet, Great Lakes, FedLoan. Those are several of the servicers out there. These loans have been available since 1993 and are the only loans that have been issued since 2010. Now, the Federal Family Education Loans, or FFEL loans for short, are issued by private lenders. So you may recognize Sallie Mae, that's one of the private lenders, but they are backed by the US government. They were first made available in 1965, but they have not been issued since 2010. Now let's look at the different repayment options available for student loans, because this is also relevant to student loan forgiveness. So the standard payment program is the default repayment option when a student loan enters repayment, which is usually about 6 months after the borrower is no longer enrolled full-time in school. Under standard repayment, the borrower makes monthly payments for 10 years, at which time the loan principal has been paid in full. Depending on the total amount you borrow, you may be able to extend the term of the loan through either extended, graduated, or graduated extended repayment, or by consolidating your loans. The maximum loan term on a consolidated loan is 30 years. So you might be able to extend your repayment period up to that long, depending on the loan amount. But just as with standard repayment, the loan principal has been paid in full at the end of the term using one of these payment options. Now, lastly, there are several income-driven repayment options available. As the name suggests, the monthly payment is based on the borrower's income, specifically adjusted gross income, not on the amount borrowed. These repayment options result in what's called negative amortization, meaning that the scheduled payments may not cover all the accrued interest and principal, so the loan balance actually increases over time. And this is where loan forgiveness comes into play. Loan forgiveness is the end result if you enroll in an income-driven repayment plan and see it through to the end. So there are 4 different income-driven repayment options currently available, and eligibility depends on what type of loans you have, as well as when the loans were originated. So income contingent repayment, or ICR for short, is the oldest plan, and is also the least favorable, has the least favorable payment calculation. However, this is the only income-driven repayment plan that is available to Parent Plus borrowers. So over time, the presidents have made tweaks and improvements to the different repayment plans. So the next iteration was income-based repayment. And it is available to those who borrowed before October 1st, 2007, and it has some improvements, and we'll look at a comparison on the next slide. Next came Pay As You Earn, or PAY. It's only available to new borrowers after October 1st, 2007. And the last one, the most recent, is Revised Pay As You Earn, or Repay, and that's available to borrowers, any borrower. Okay, so taking a look at the differences between these various income-driven repayment plans. The first is the way in which discretionary income is calculated for purposes of determining the monthly payment. So the starting point is adjusted gross income, from which is subtracted either 100 or 150% of the federal poverty guideline according to family size, and there are charts. I'm not going to go into the details of those numbers. The next step to calculate the payment is a percent of that discretionary income calculation divided by 12 months. So that's how you arrive at the monthly payment. Now, in order to qualify for IBR and Pay As You Earn, you must experience a partial financial hardship. Now, what that means is that the payment calculation as a percent of your discretionary income may not exceed the standard 10-year payment. So when that occurs, so if somebody starts out in one of these programs and then at some point their income increases to the point that the calculated payment is greater than it would have been under the standard plan, the borrower must exit the program, and any unpaid accrued interest is capitalized into the principal balance, although the amount that capitalizes is capped under the Pay As You Earn program. A note for all these programs, you must recertify your income every year. So you have to, if you don't recertify, then you will be exited from the program against your will. And you may ask, because a couple of these don't require partial financial hardship, so why would you choose an income-driven repayment plan if your calculated payment exceeded the standard payment? And the answer is you probably wouldn't. However, if you are in a career that has a low starting salary, but you expect that salary to grow considerably, you may want to choose income contingent repayment or revised Pay As You Earn to avoid having the accrued interest capitalized into the loan balance. You may end up paying the loan principal and accrued interest in full before the end of the loan term, but you won't pay interest on interest, which is what happens when that capitalizes. Now, the various income-driven plans have a forgiveness period. So after 25 years, any remaining accrued interest and principal is forgiven. And that ranges from 20 to 25 years, depending on the plan. Now, eligible loan types. So you can see on the slide that the only program that the family federal education loans are eligible for is income-based repayment. So you must have direct loans to be eligible for the other three types of plans. Now, if you don't have, if you have the federal family education loans and you want to qualify for some of these other income-based repayment options, you can consolidate. So you can do a direct consolidation. Now, your interest rate might go up slightly. It can go up to 1/8%. But there are things you'll want to consider if you're thinking of taking that route. Again, I won't get everyone's situation is unique, so I won't get into those issues. But reach out if that's something you want to consider, and we can talk it through. And then the tax treatment of loan forgiveness. So under normal circumstances, the loan forgiveness is taxable. So you can end up having what we call a tax bomb at the end of this loan forgiveness period. Now, this is where the American Rescue Plan, made this change where the treatment of all types of student loan forgiveness is non-taxable through 2025. So any loans that are forgiven up until 2025 will be non-taxable. So that's a big deal. So let's look at a specific scenario. So we have Larry the lawyer here. So he currently has an adjusted gross income of $80,000 a year, and he is married, so he files married filing jointly. We will assume for this situation, the scenario, that his income increases 5% per year, and that if his family size stays the same through the life of the loans. So you can see in the second column, his initial monthly payment under each of the plans, and then the ending monthly payment. So, it starts out lower. Let's look at pay as you earn. Starts out at $455 a month. His final payment towards the end of the term is $1,336. So it goes up over that term. So he pays, here's what he pays: a total of, depending on the plan, around $200,000 over the life of the loan, up to $440,000. And then there's, depending on the program he chooses, the amount forgiven. And then there's the federal tax bomb. So this is the key when considering this, is what could you end up paying taxes on down the road? So he could end up paying taxes on as much as $104,000 of extra quote unquote income 20 years down the road. So, that's something that needs to be planned ahead for if you want to take advantage of any of these quote unquote forgiveness programs. So these are the broad, widely available loan forgiveness programs. There are a number of miscellaneous and very specific loan forgiveness programs. I'm not going to go into all of these, but I do want to talk about several. I want to pull out several of the more common ones, starting with public service loan forgiveness. And one feature of many of these programs is that the loan forgiveness is non-taxable. So unlike the widely available loan forgiveness programs under the income-based repayment, these are actually, the forgiveness is not taxed. So let's talk about public service loan forgiveness. So there's been a lot of press about the extremely high rejection rate for public service loan forgiveness applications. And this is due to the fact that most of these borrowers either had the wrong type of loan, or they were in the wrong repayment plan, or they didn't submit the proper documentation. And the rules are very convoluted and unclear. And unfortunately, the loan servicers are not terribly helpful in helping people navigate the complex rules. And as I mentioned, just to reiterate, as I mentioned at the beginning of the presentation, if you are enrolled in public service loan forgiveness or another loan forgiveness program right now, you are receiving credit for the deferred payments under the COVID relief measures. So they won't be tacked on to the end of the loan forgiveness term. So that's good news. But let's talk about the 5 requirements for public service loan forgiveness. And I'll go into each of these one at a time. So first of all, you need to work full-time for a qualified employer, which can be a government, nonprofit, 501c3, or private nonprofit that provides certain public services. Now, full-time under public service loan forgiveness is the greater of the employer's definition of full-time work, or 30 hours per week. And you can actually have multiple qualifying jobs that total 30 hours per week or more, and that can count towards public service loan forgiveness. So that's the first hurdle. The second is that you need to make 120 qualifying payments, so that, if you're done consecutively, it's 10-year forgiveness period, but they do not have to be consecutive. So you could work in the public service sector, go to the private sector for a couple of years, and then if you return to the public service sector, you can then start having those credited towards your public service loan forgiveness requirement. Next, you must have the right type of student loans. It must be a direct loan. You must have a direct loan. If you have one of the, again, as I mentioned, if you have one of those, the FFEL loans, then you will need to consolidate into a direct consolidation loan in order to be eligible for public service loan forgiveness. The fourth requirement is that you must be in a qualifying income-driven repayment plan. So the four that I mentioned, ICR, IBR, pay-as-you-earn, and revised pay-as-you-earn, all qualify. But also payments that you made under standard tenure plan count towards forgiveness. So if you've been making payments for a couple of years before you enroll in public service loan forgiveness and you were employed by a public service employer during that time, then those payments will count. Now, the extended and graduate payment plans do not qualify. They are not qualifying repayment options for public service loan forgiveness. And then the last, and this is probably the most critical requirement, is that you must submit the public service loan forgiveness and temporary expanded public service loan forgiveness certification and application. That's a mouthful. There used to be two forms, but now there's one multi-purpose form. So it's used three ways. The first is to initiate the transfer of your loans to FedLoan, which is the only servicer that works on PSLF, or that services public service loan forgiveness program. Now, if you submitted an application, an initial application during this last year, when we've been in the deferment period for the COVID relief, the servicers were not processing the applications. They received them, they accepted them, but they had not been processing them. They have now resumed processing those applications. So you should hear something in the next couple of months about your loans being transferred to FedLoan. But if you don't, it is certainly worth reaching out to your loan servicer to make sure that they're working on it. The second purpose of this form is to certify your employment for a qualifying employer on an annual basis. So when you first fill out the form, you can, fill in your work history if you've worked in the public service sector for several years. You can list that on the form. They will send you a letter giving you, stating how many months you have towards qualifying. But then you will have to recertify every year, and they will not recalculate the payments unless you submit the form. So you want to keep on top of that. And you want to make sure that they're crediting properly. And then the last way this form is used is to trigger the review process for the actual loan forgiveness after you have made 120 qualifying payments. So at the end of the process, you have to submit the form again for the final certification, and you must remain in the qualifying job until the entire process is complete. If you submit the final application, and then leave the job before getting confirmation of forgiveness, that just cancels the whole, or it doesn't cancel it, but you won't receive forgiveness. You have to remain in the public service job until you receive notification that your forgiveness has been granted. So teacher loan forgiveness. So there's a little bit of overlap here between teacher loan forgiveness and public service loan forgiveness. So by definition, teachers qualify for public service loan forgiveness. But teacher loan forgiveness may be a better way to go if you teach full-time for 5 consecutive years in a low-income school or education service agency. Under teacher loan forgiveness, either direct or FFEL loans qualify, so it's a little bit more broad eligibility in terms of the loan types. But the forgiveness is capped at $17,500, and it depends on the field that you are teaching in. Now you can use both teacher loan forgiveness and public service loan forgiveness, but the payment clock will restart if you switch programs. So let's say you go through teacher loan forgiveness, have up to $17,500 of your loans forgiven. If you want to enter public service loan forgiveness, then you start the clock and you have to then complete 120 qualifying payments to get public service loan forgiveness. So it kind of makes sense if your loan balance is significantly higher than $17,500, you probably just want to start with public service loan forgiveness. Again, you have to make some calculations. to make sure that that's the best way to go. The closed school discharge. Now this is interesting, and the reason I bring it up now, so this, there were a lot of the for-profit schools that closed, and that's the original reason that this program was initiated, was to provide relief for folks who were in some of those for-profit schools that closed down. It should be automatic within 3 years of school closure if certain conditions are met. But with COVID, a lot of the universities and colleges, even the not-for-profits, have suffered financially. So, this could be an issue again, if those schools cannot recover financially from the hit they took from, losing the tuition from students not being able to attend in person. So your loans can be forgiven if you qualify under a total and permanent disability. Now, this definition is extremely strict. So you can provide documentation from the VA of 100% service-connected disability, or documentation that you're totally disabled based on individual unemployability rating. You can also provide Social Security Administration documentation of eligibility for SSDI or SSI, where your next scheduled review is 5 to 7 years or more from the date of your last determination. Or you can provide a physician certification that you are unable to engage in any substantial gainful activity due to physical or mental impairment that can be expected to result in death, has lasted for a continuous period of at least 60 months, or can be expected to last for a continuous period of at least 60 months. So the criteria is very strict. It's even more strict than qualifying for regular Social Security disability, but it's out there in case you have a total and permanent disability. It's available. And then the last one I wanted to highlight was the Parent Plus loan forgiveness. So Parent Plus loans are eligible for forgiveness in certain circumstances. So if the parent dies, then the loan can be forgiven. However, if both parents sign the loan and one parent dies, the loan will not be forgiven. So this would be in the case that only one parent signed on the loan and that parent dies. If the parent becomes totally and permanently disabled, according to the definition on the previous slide, then the loans are eligible for forgiveness. If the student borrower dies, then the loan is eligible for forgiveness. And then if the student borrower themselves is eligible for forgiveness due to closed school discharge, false certification, unpaid refund discharge, which are very specific types of loan forgiveness, then the Parent Plus loan is also eligible for forgiveness. So you're probably getting the idea that loan forgiveness is pretty complicated to navigate, which is why I will be happy to answer your questions offline for your specific situation. But some other resources for you are the Federal Student Aid website of the Department of Education, and there is a page on student loan forgiveness. And also the Consumer Financial Protection Bureau has a section on student loans. And as I mentioned at the beginning, you can email your questions to me at leslie@lifetimeasset.com. So with that, we started this Lifetime Learning Series because we were passionate about financial literacy and sharing knowledge and expertise on important topics. That's why we host these webinars and open them up to anyone in the community. And as a reminder, if you have questions about your specific loan situation, you can email me directly. And we have more great webinars coming your way. The current schedule is the first and third Thursday of each month, so mark your calendars and head to our website for more information about upcoming topics. Our next webinar is going to be on May 6th and is going to feature Matthew Glova, who will demo the eMoney Wealth Management Client Portal. So don't miss this chance to learn some tips and tricks for maximizing the use of this tool. And our last webinar of the season will be on May 20th, and will feature Doug Orden of MFS Investment Management, who will discuss generational family wealth and how to start the wealth transfer conversation within your family. After this webinar, we will be taking a summer break, after the webinar on May 20th, that is, but the Lifetime Learning Series will return in the fall with more informational and timely topics. So thank you for your time today. And as a reminder, we'll share a recording of this session soon, so keep an eye out for that. And we'll see you next time. Thank you.